The strength of Under the Radar Report is our ability to deliver institutional grade research to subscribers. What we have quite a big team now, and we have people based offshore, so we have people looking at offshore markets, and one of the things Big Value does is look for value. And value is always at the front and centre of Under the Radar. At the small cap sort of end of the spectrum where we specialise, we look at sort of small caps trading at value prices, but with big growth potential. At the big cap end of the spectrum, we're looking just purely for value. So the value differential between the racy, fast growth end of town and the value end of town has widened. And that's why we think there's some great opportunities at the big cap end of the spectrum. And I guess like what we're doing is looking at big events, like in the next issue we come up with an analysis of the infrastructure spend in the US and what that means for companies who have ASX companies who have earnings based in the US and that are leveraged to infrastructure, as well as some interesting stocks like Cemex, which is a Mexican company based in the US, which is a cement manufacturer. So we do provide definitely an international flavour, but there is the basis of looking for value on the ASX. Over and above these big events that happen in the world, there is value on the ASX and at the big end of town, and we do look in detail at some of the stocks where we see big value. One of those stocks is Telstra, which we put under the microscope. So it'll be worth people reading what our analysis is there, because what we are at Under the Radar Report is independent. So we don't have an interest in any corporate advice to Telstra. Our only interest is in whether Telstra goes up or down and where the value is. So I guess one of the things Big Value will do is look at the big end of town and where there is deep value, like where we think the dividends are maintainable and where we think the market's probably oversold, and there's the chance to reap long-term rewards for investors. On that front, like bringing kind of the institutional world to the subscriber, we've got the addition of Sam Ferraro. And Sam comes from Goldman Sachs and previously with JB Weir, and he's a fund manager, but also he continues to give advice to institutions. So he'll be running our big value portfolio, which will consist of 15 to 25 stocks. The general, I guess, trend at the big end of town in the investment world is for people to use what they call a core satellite approach. So they'll use a Vanguard or some ETF that mirrors the market, but then try and get outperformance from a high conviction portfolio. And what small caps do is they provide that high conviction element of a portfolio, and what Sam's big cap portfolio does as well with the 15 to 25 stock limit, it provides that high conviction portfolio at the big end of town, because Sam's not interested in kind of marking time with the market. He's looking to outperform. So he puts in a number of overweight and underweight positions in stocks like BHP, Rio Tinto and Telstra and the banks. So it's interesting to hear what Sam says in terms of how he builds up a portfolio, and that's what we talk about in the next few issues, is how you can create your own high conviction portfolio. With small caps, we're interested in high return on equity companies or high return on investor capital companies, but we're not. I guess we're happy if they reinvest their excess profits. With big cap companies, we're not as happy as if they invest those excess profits. So consequently, with the big cap companies, we're looking for, I guess, ones that aren't going through big capex humps like TPG. So I guess what you're looking for out of big caps is more of a return of capital, a more stable income stream. And as an investor, you want both. You want that high growth element, but you're also looking for that income that's going to pay the bills, both now and in the future.